U.S. President Donald Trump showing no signs of backing down from his tariff agenda as old complaints about Canada surface again, adding to the already tense relationship.
Canada is not open to us. They need to open their market. Unless they're willing to open their market, they're going to pay a tariff.
The Trump administration has repeatedly changed the goalposts around what they want from Canada in order to lift tariffs.
Son tarif, il n'y a pas beaucoup d'évidence.
It's to the point the Prime Minister is lowering expectations that tariffs will come off, even if Canada can reach a deal with the U.S. before the August 1st deadline. So far, no country has reached a tariff-free deal with Trump.
Canada just torched $58 billion in U.S. Treasury bonds. This isn't a trade spat, it's financial warfare by America's closest ally. They orchestrated a controlled demolition, liquidating $58 billion in bonds while purchasing new ones. This calculated retaliation timed with Trump's tariffs weaponized their holdings. The immediate impact was seismic. Treasury yields spiked by 0.5 percentage point, with the 10-year note hitting 4.5%, a rapid shift. Canada wasn't alone. Intelligence suggests coordination with Japan, the EU, and China. The message: escalate tariffs and we'll undermine American financial power. The U.S. Treasury market is the bedrock of global finance. Canada understood this leverage. Within days, Trump paused his tariff escalation. This is economic warfare's new reality. Military might matter less when adversaries strike the financial jugular. If Canada can disrupt, imagine China. We're witnessing financial mutually assured destruction. What do you think about this unprecedented move? Drop your thoughts in the comments, and don't forget to subscribe, like, and share the video. What happened next was a masterclass in multilateral financial warfare. The coordinated response to Trump's tariff threats exposed the vulnerabilities at the heart of American economic power. Beyond Canada's sell-off, a broader strategy unfolded involving Japan, the EU, and China. Japan's treasury holdings showed volatility. The EU diversified reserves, increasing gold. China subtly reduced new treasury purchases. This remarkably coordinated multi-country effort employed a rolling pressure campaign, maintaining constant stress on U.S. debt markets. Psychological warfare forced policymakers to assume the worst-case scenario. The impact on treasury markets was unprecedented. The U.S. government bond, long the ultimate safe haven, saw yields rise as equities crashed, becoming a source of risk. This inversion destabilized asset classes and weakened the dollar. The crisis revealed the limits of American financial power. For decades, the U.S. used its financial system as a foreign policy tool. But when pushed, even close allies weaponized their investments, challenging dollar dominance. The speed of this coordinated response was remarkable. Within days, Trump was forced to pause his tariff escalation. Allies demonstrated America's economic dominance was not unassailable, establishing a new form of deterrence. The events of April 2025 marked a fundamental shift. Financial weapons became the primary tools of international relations. America's closest allies demonstrated their willingness to use them, shattering the long-held assumption that U.S. Treasury bonds were the ultimate safe haven. If treasuries could be sources of instability, global risk management needed rethinking. Central banks are now actively diversifying reserves, reducing U.S. debt exposure, and increasing holdings of gold and other currencies. Gold, for instance, has gained 17% since early 2025, reclaiming its historical role as a true store of value, while treasuries are relegated to just another asset class. The dollar's exorbitant privilege, its ability to finance deficits by printing money others eagerly hold, is profoundly shaken. We're seeing the early stages of a multipolar currency system, with the euro, yen, yuan, and even digital currencies gaining ground. This diversification significantly reduces America's financial leverage on the global stage. Geopolitically, financial warfare offers a powerful middle path between acquiescence and open conflict. Countries now view financial relationships strategically, seeing treasury holdings not just as assets, but as potential weapons. The precedent set by Canada and its allies provides a clear playbook for resistance against unilateral U.S. actions, a lesson China, with its massive treasury holdings, has certainly noted. Domestically, the forced retreat on tariffs exposed the limits of American economic power. Future administrations must acknowledge these financial vulnerabilities. Even the Federal Reserve faces new complexities, as foreign holders can now weaponize their treasury positions, complicating monetary policy. Expect continued evolution in financial warfare. The rise of digital currencies and alternative payment systems will further reduce dependence on the dollar-dominated system. Technologies like blockchain and central bank digital currencies offer new pathways around traditional American financial control. This is nothing less than the emergence of a new world order. Financial power is more distributed, traditional allies are willing to challenge U.S. dominance, and economic warfare is becoming as crucial as military might. The era of unquestioned American financial dominance is over. How quickly all parties adapt to these new rules of engagement will define the future. What are your thoughts on this new era of financial warfare? Let us know in the comments, and remember to subscribe, like, and share this video. The headlines in Europe were subdued. No breaking news banners, no dramatic announcements, just a quiet line buried deep in an ECB press briefing. The composition of reserve assets is being reassessed in light of global volatility. But behind those carefully chosen words was a coordinated financial maneuver of historic scale. 2 days after Canada's $57 billion fire sale of U.S. Treasuries, financial regulators in Frankfurt, Brussels, and Paris began executing their own strategy, selling off nearly $40 billion in American debt across multiple central banks. By July 20th, the EU had quietly divested nearly $84 billion in U.S. bonds over a rolling 90-day period. Let that sink in. This wasn't a market fluctuation. It was a movement. What makes this exodus even more alarming is that it wasn't just about the money, it was about trust. Trust in the United States as a reliable trade partner. Trust in its leadership, and perhaps most painfully, trust in its currency. So what drove Europe, America's most historic ally, to begin peeling away its financial allegiance? It started with a meeting in Luxembourg back in April, shortly after President Trump announced a new set of tariffs on European EVs and semiconductors. The move sent shockwaves through Germany's already fragile manufacturing sector and sparked outrage in the European Parliament. French President Emmanuel Macron was among the first to publicly rebuke Trump. Protectionism masquerading as nationalism, he called it during a fiery speech in Strasbourg. German Chancellor Annalena Baerbock went further. "This is not negotiation, it's intimidation. Europe won't be cornered." But it wasn't just speeches this time. The EU, traditionally cautious when it comes to confronting Washington, decided to act with quiet resolve. Behind closed doors, the European Central Bank and national central banks across the Eurozone began shifting their reserve strategies. A larger portion was moved into gold, the Chinese yuan, and even emerging market currencies, anything to reduce dependency on the dollar. And the math made sense. In the past 12 months, the U.S. debt-to-GDP ratio had ballooned to a record 138%, spurred by tax cuts, military spending increases, and Trump's escalating global trade war. Add in rising interest rates and a declining dollar, and you have a perfect storm of risk for foreign bondholders. But geopolitics may have played the largest role of all. According to documents leaked from a confidential G7 briefing, European finance ministers were increasingly concerned about Trump's unilateralism and his tendency to weaponize economic tools, even against allies. The tariffs were the tip of the spear. The real fear was what came next: restrictions on capital flows, sanctions on EU firms operating in Africa and Asia, and even threats to NATO funding mechanisms tied to economic compliance. In other words, Europe wasn't just pulling money, it was pulling away. And the message from Brussels was clear. If Washington was going to play hardball, so would the EU. To illustrate just how serious the shift is, consider this. As of July 1st, the percentage of EU foreign reserves held in US dollars fell to 42%, down from 61% at the start of the year. That's the fastest drop in over 3 decades. And there's a psychological element to all of this. For years, US Treasuries were considered the safest asset on Earth, the ultimate backstop, the default plan B for central banks and foreign governments alike. But today, that certainty is evaporating. A senior official at the European Investment Bank put it bluntly in an off-the-record interview. The question isn't whether America will pay its debts. The question is whether it will still be the center of gravity when it does. And as European nations unload treasuries, the impact is being felt at home in the U.S. Treasury Department, where bond auctions are seeing weaker foreign participation, driving yields higher and making borrowing costlier for the federal government. That, in turn, increases pressure on the U.S. budget and interest obligations. ironically inflating the very debt load Trump says he wants to contain. It's a dangerous loop, and we haven't even reached the full fallout yet. In Part 3, we'll turn our attention to China. The dragon is stirring again, and Beijing's next move may reshape the global order even more dramatically than Washington or Ottawa ever imagined. Stay with us. The storm is only beginning to gather. State Administration of Foreign Exchange confirmed it had offloaded $23.6 billion in U.S. government bonds. At first, it appeared to be a routine rebalancing, but as the week wore on, more sell orders came in. By the end of July, the figure had surpassed $61 billion. The timing wasn't a coincidence, it was a message, and not a subtle one. President Xi Jinping had remained relatively restrained since Trump returned to power earlier this year. But beneath the surface, tensions had been boiling. In March, Trump had imposed a new round of Section 301 tariffs, targeting Chinese AI hardware and pharmaceutical imports, two sectors Beijing had spent years developing through its Made in China 2035 inches strategy. Beijing initially responded with diplomatic statements and symbolic trade bans, but Trump wasn't done. In May, he announced the creation of a Strategic Trade Monitoring Council designed to track and potentially block Chinese investment in U.S. agricultural land, ports, and even data centers. Then came the kicker, an executive directive demanding the delisting of Chinese firms from U.S. stock exchanges unless they complied with new federal audit standards within 90 days. China saw these moves not just as economic pressure, but as economic warfare.
A veteran trade analyst from the China Center for International Economic Exchanges told Xinhua, "What we are witnessing is not diplomacy, it is siege warfare using spreadsheets."
But Beijing didn't panic. It recalibrated. In the weeks leading up to the Treasury offload, China accelerated its purchases of Brazilian and Nigerian sovereign bonds. It also inked new currency swap agreements with Russia, South Africa, and Indonesia, fortifying its ability to conduct bilateral trade in yuan instead of dollars. Then came the announcement from the People's Bank of China, the launch of a new sovereign digital currency corridor with the Shanghai Cooperation Organization, SCO, allowing member countries, including Pakistan, Kazakhstan, and Iran, to bypass the US-dominated SWIFT system altogether. In short, China wasn't just divesting from US treasuries, it was building a parallel economic architecture, one that didn't need Washington at the center. The financial consequences of China's treasury dump were immediate. Bond yields spiked again. The dollar wobbled against a basket of global currencies, and the Dow dropped nearly 700 points in a single day as investor confidence eroded. But the geopolitical implications were even more profound. Beijing's move sent a signal to developing nations around the world. America's grip on global finance isn't what it used to be, and you don't have to play by its rules. Already, analysts are tracking increased yuan-denominated transactions across Southeast Asia and parts of East Africa. The Chinese digital yuan, once seen as a novelty, is now gaining ground as a legitimate reserve instrument. And it's not just among China's allies. Even neutral nations like Turkey and Argentina have begun holding portions of their reserves in yuan. Back in Washington, the Trump administration dismissed the sell-off as desperate posturing.
In a press conference, Treasury Secretary Stephen Moore called China's actions reckless and ultimately self-defeating.
But market analysts disagreed.
"It's not reckless, it's coordinated," said Julia Moreno, head of global macro strategy at Cipher Group Capital.
You've got Canada, the EU, and China all moving against U.S. treasuries. That's not random, that's systemic realignment. Even former Trump advisor Steve Bannon voiced concern, stating during a War Room podcast episode,
"If we don't recalibrate our economic strategy fast, the world reserve currency might not be the dollar in 5 years. That's not alarmist, that's math."
As this realignment unfolds, America's ability to borrow cheaply is rapidly eroding. With foreign appetite for U.S. debt shrinking, the Federal Reserve has been forced to step in as the buyer of last resort, triggering fears of inflation, currency debasement, and a credibility crisis. But perhaps most dangerously, the White House doesn't seem to be pivoting. Instead, Trump has doubled down, proposing an America-only infrastructure act that would fund $1.3 trillion in domestic projects using entirely U.S. materials, regardless of cost or international fallout. That bill, currently stuck in the Senate, could become the next flashpoint, and the rest of the world is watching. In our final segment, Part 4, we examine the long-term consequences of this global cash-out. What does it mean for the average American? How will it impact U.S. foreign policy, inflation, and the cost of living? And, most crucially, can the dollar survive this coordinated defiance? Stay with us. This isn't just a financial story. It's the beginning of a new global order.
Insists this is not the end of free trade with its neighbors.
No, see, that's silly. We have a plan called USMCA, U.S.-Mexico-Canada Agreement. Virtually 75% of all goods coming from Mexico and Canada already come in tariff-free.
Canada has carve-outs for some tariffs related to the auto sector, border security, and fentanyl, covering goods that are compliant with the current free trade deal. As the U.S. suggests that will remain the case, Trump's critics are mocking his trade strategy.
You know, if you're over the age of 5, you've dealt with hucksters and con men. Everything's going to be great in 2 weeks. By August 1, we're going to have a deal.
The American dream has always been backed by something invisible: trust. Trust in its economy, trust in its government, trust in its money. But now, that trust is being tested like never before. The coordinated sell-off of U.S. Treasuries by Canada, the European Union, and China has sent shockwaves through the global financial system. But beneath the headlines and economic jargon, there's a more haunting question surfacing in homes, boardrooms, and policy centers across the United States. What happens if the world stops believing in the dollar? The immediate fallout is already apparent. Mortgage rates, which hovered around 6% earlier this year, have spiked to nearly 8.4% as Treasury yields rise. Federal borrowing costs have jumped by nearly $350 billion in just 3 months, driving urgent revisions to the national budget. Social programs are now under review, and Congress has begun debating emergency fiscal measures not seen since the COVID-19 era. The average American may not know the intricacies of international bond markets, but they feel the tremors. Groceries are more expensive, car loans are harder to secure, credit card interest is climbing, and inflation, though down from its 2022 peak, is back on the upswing. Worse still, the sense of financial security that undergirded American life is slipping. In July, the IMF downgraded the U.S. economic outlook for 2026, citing persistent fiscal pressures, rising yields, and waning global demand for U.S. debt. That's a diplomatic way of saying, the world is turning away. But this story isn't just economic, it's geopolitical. America's power has long rested not only on its military might, but also on its financial leverage. The ability to impose sanctions, to fund overseas operations, to dictate the terms of global trade. All of it is rooted in the dominance of the dollar and the liquidity of U.S. Treasuries. Now, both are under threat, and our adversaries know it. Russia has quietly followed China's lead, shifting more of its sovereign wealth fund into gold and crypto-backed assets. The BRICS Plus alliance, now including Saudi Arabia, Iran, and Egypt, has announced a new plan to launch a common digital settlement platform by the end of the year. Its goal? To reduce member dependency on Western financial systems. In Africa, leaders from Burkina Faso, Kenya, and Algeria have voiced support for an African monetary sovereignty pact that encourages nations to diversify away from U.S. dollar reserves. They're calling it economic decolonization. Meanwhile, Trump continues to frame the sell-off as a badge of honor.
They're mad because we're strong again, he told a crowd in Cleveland. We're not begging anymore. We're leading. If they want to sell, let them. We'll build our own economy with American steel, American workers, and American pride.
It's a powerful message, especially for voters feeling abandoned by globalization. But it's also a gamble. Because if Washington can't find buyers for its debt, it may have no choice but to monetize it, printing more dollars to fill the gap. That's a recipe for inflation, for a weaker currency, for a shaken middle class. And so, the question becomes, how far can America go on pride alone? As the world reconfigures its financial loyalties, the U.S. stands at a crossroads. It can recalibrate, engage allies, rebuild trust, and restore its place as a steward of global stability. Or it can retreat further, digging deeper into unilateralism while its financial foundation quietly cracks beneath it. The dollar won't collapse tomorrow. But for the first time in modern history, its future is no longer certain. This is more than a backfire. It's a reckoning. We want to hear from you. Is this the beginning of a new financial world order? What should the U.S. do next? Drop your thoughts in the comments, and if you found this report valuable, Hit that like button, share it with others, and subscribe for more unfiltered global analysis.